Exchange-traded funds, or ETFs, are investment funds that are traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, commodity, currency, or a mix of various asset classes. So, here's a detailed explanation of ETFs. Structure of ETFs. First, we have the pooling of funds. ETFs pool money from many investors to purchase a diversified portfolio of assets. This can include stocks, bonds, commodities, or other securities. Next, we have shares. Investors can buy shares of the ETF on an exchange, which represents a fractional ownership of the fund's underlying assets. Types of ETFs. Index ETFs aim to replicate the performance of a specific index, such as the S&P 500 or the Dow Jones Industrial Average. Sector and industry ETFs focus on specific sectors of the economy, like technology or healthcare or specific industries. Bond ETFs invest in a portfolio of fixed income securities, including government and corporate bonds. Commodity ETFs track the price of a commodity, such as gold or oil, or a group of commodities. International ETFs invest in foreign markets, allowing investors to gain exposure to global economies. Lastly, thematic ETFs focus on specific themes or trends, like renewable energy, artificial intelligence, or infrastructure. The benefits of ETFs are numerous. First, diversification. By investing in an ETF, investors can gain exposure to a wide range of securities, reducing the risk associated with investing in individual stocks. Next, liquidity ETFs trade on major stock exchanges, allowing investors to buy and sell shares throughout the trading day at market prices. Additionally, lower costs. ETFs typically have lower expense ratios compared to mutual funds because they are usually passively managed and track an index. Lastly, tax efficiency. Due to their structure, ETFs tend to have lower capital gains distributions compared to mutual funds, making them more tax efficient for investors. Understanding how ETFs work is crucial. It starts with creation and redemption. Authorized participants, usually large institutional investors, can create or redeem shares of an ETF by exchanging a basket of the underlying assets. This process helps keep the ETF's share price close to the net asset value, or NAV, of the underlying assets. Then, there's pricing. The price of an ETF share fluctuates throughout the trading day based on supply and demand, similar to stocks. There are several considerations for investors when it comes to ETFs. First, trading costs. While ETFs are generally low cost, investors should be mindful of brokerage commissions and spreads, which can affect returns. Then, market risk. Like any investment in the stock market, ETFs carry risks, including market fluctuations and the specific risks associated with the underlying assets they hold. Finally, research and due diligence. Investors should research an ETF's holdings, performance history, and expense ratio before investing, ensuring it aligns with their investment goals and strategies. In conclusion, exchange-traded funds, or ETFs, are a flexible and cost-effective way for investors to gain exposure to a diversified portfolio of assets. They combine the advantages of mutual funds and stock trading, making them an attractive option for both beginner and experienced investors looking to diversify their portfolios.